Welcome to Stifel's Investment Strategy Brief, a monthly recap of the macroeconomic and market environment.
Well, greetings and welcome to the Investment Strategy Brief podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. Hey, in this episode, I want to get into the concept of headwinds and tailwinds. So we had a bit of a tailwind show up with the Fed cutting rates a half a point at its September meeting. And of course, a set of market participants expecting and wanting more. So we'll get into that a little bit, but also identify some other tailwinds and maybe some potential headwinds for both the economy and the markets. So anyway, let's jump into it. I guess just start with another tailwind is the idea of artificial intelligence and its influence on things. We've been talking about that quite a bit. And by the way, in our body of work, we have a report that really frames up our long-term investment themes. We've just reissued that report, sort of an update to it. So themes like the fourth industrial revolution, where technology is changing our world, or securing strategic resources around energy and water and materials, shifting demographics as the population evolves. What does that mean in terms of consumption and things of that nature? And then on consumption, the new consumer, the idea that the way things get done in terms of purchasing goods and services changing, a lot of digitalization in that. And then productive competition, companies and countries competing. And as it relates to AI, basically, as I've talked about before, it's sort of woven across all five of those themes in a way. And we've been focused on it to a point where we included a nice article in our original Outlook report in January, where we talked about really the idea of what the opportunities are. They're the enablers and the hyperscalers of artificial intelligence. They're the innovators, companies that are going to take advantage of it, and then eventually disruptors of segments of industries or industries with the use of AI. And we've gotten into, examples of uses of AI. So these days, you can imagine video production as a good example of something where it's really going to probably be disrupted, or drug discovery or surgery, robotic surgery, or back to consumption, maybe automatic checkout, where you just kind of pick up your stuff and walk out of the store, or, precision farming, which we've talked about, just tons of use cases. And yet when we look across the sectors, a couple observations, really, it's still early days, right? Single digit, typically, beyond sort of technology firms and infotech type firms. It's basically single digits in terms of companies that are using AI, but growing pretty aggressively. And so that's something we'll keep an eye on. We know also that between AI and crypto, there's a big increase in demand for energy from data centers. And again, sort of the creation of cryptocurrencies. And then when it comes to the hyperscalers, so these are the companies like Microsoft with their Azure platform, with Meta, Amazon with AWS, and Google Cloud. Those are sort of the hyperscalers of AI. And those companies have, as we've discussed before, have invested a lot of CapEx into AI. And so, the bottom line is, of course, it feels like a really good tailwind, but the headwind just relates to, well, wait a minute, if we're putting this money into this functionality, when are we going to see that in earnings and sort of ultimately a return on our investment? So that's an important tailwind, but with a little bit of a, pause to say, well, wait a minute, we've got to keep an eye on things. In any event, talking about the economy more broadly, the economy is surprised to the upside in the second half. There's some data showing that we may see that same thing happen in the third quarter. So really, things kind of holding up well. And recall that the consumer makes up about 2/3 of the economy. And so the bottom line is it's been surprisingly strong, especially consumer spending. And, part of that might be the wealth effect. Stocks are near all-time highs, and so people are feeling good about the value of their portfolios. That does incrementally lead to kind of additional spending. And yet when we watch the data, take, for example, one traditional thing to look at is the manufacturing sector purchasing managers indices. These are survey surveys of managers in the manufacturing sector. And oftentimes when that falls into a contractionary state by these PMI measures below 50, that's an indication that we're headed towards a slowdown in the economy. And so that's basically happened for both the S&P Global Manufacturing PMI and the ISM Manufacturing PMI. So that's something that people are keeping an eye on. Another thing which we've talked about before is as we monitor earnings release meetings, sort of presentations from CEOs typically, what we're seeing is an increase in the number of comments that talk about the consumer feeling financially strapped or under some pressure or needing to extend their budget, and being more discriminating, right? So softly, we're seeing information that's telling us, hey, the consumer is slowing down a little bit, and that does line up with both sentiment and confidence levels for the consumer being a bit below long-term averages, and sort of therefore sort of signaling that the consumer is a little cautious. Retail sales has bumped around. It's actually, the latest report was a little bit firm, meaning they've held up okay. But the consumer as well is facing an increase in their interest on their debt, and honestly, an increase, as we've talked about before, in the balance that are delinquent. And so we're seeing these little stresses in the consumer, but again, in terms of ultimately spending, they've held up pretty well. Now, as it relates to then the economy and where we've been and where we're headed, the Fed and where the Fed goes from here, that's very important. And as I mentioned, that 50 basis point or half point rate cut in September is a bit of a tailwind for the economy and ultimately the markets. We do see a nice foundation of good reporting on inflation. So in other words, the Fed has depended on that. And specifically, when we look at the consumer price index and the producer price index, the average over the last 6 months has basically sat really close to 0.17%, which is the monthly equivalent of the Fed's 2% target. So they've seen this data indicating that, inflation has cooled down and has stayed down. And in fact, when we unpack sort of what we learned from the Fed meeting, a quote from the statement, quote, "The committee has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance," end quote. So basically, the bottom line is, as we've seen a softening in the labor market, the job market is still pretty good, but a softening that's caused the Fed to take a step back, focus not only on inflation, but increasingly on jobs. And it was one of the motivations to go ahead and make this first cut. Now, the other thing, though, is that everybody says, okay, this is the beginning of an aggressive move on the part of the Fed, and the Fed's going to do more. And so verbally and in the statement, the Fed's hedging. They're saying, so for example, in the statement, quote, "In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks," end quote. And so that coupled with that is from Jerome Powell, so the chair's press conference after the meeting, quote, "We are not on any preset course. We will continue to make our decisions meeting by meeting," end quote. So the punchline is that I'll explain that one report, part of their report is signaling more, but they're, as they always do, they're sort of fudging that a little bit, hedging that a little bit to say they're going to give themselves room to act more or less, depending on what they're seeing. Now, as it relates to anyway that other report, it's the summary of economic projections that they issued again here at the September meeting. In that, essentially, they're polling each of the individual officials and then giving us some statistics about that. In this case, the median outlook, for example, is for 2 more quarter point cuts, so another half point this year, and then a total of 1% next year, with also forecasts signaling a median that they believe that GDP growth is going to be strong, call it around 2%. That's a little bit above economist consensus, for example. And that unemployment will rise a little bit to 4.4, but sort of stay there, which is not a bad number. So anyway, long story short, the Fed is signaling some optimism, but also signaling that they're going to keep an eye on the data. And as it relates to then what the market has adjusted to, the market now is calling for actually 3 more quarter point cuts by the end of the year. So again, that sort of debate will continue. Some people were hoping, hey, we're going to learn definitively what the Fed's plan is, but they're going to as ever be mindful. And as it relates to this, okay, we've talked about this as a tailwind, but a headwind would be if these moves start to reignite inflation, right? So the risk that we're monitoring is of policy error when it comes to monetary policy. And if they cut too quickly, we can see inflation come back. If they go too slow, we can roll into a recession. And so I've been using the phrase thread the needle. The Fed's trying to thread the needle as it relates to the economy. And anyway, as it relates to consensus views going forward, so the consensus view for 2025 is a 1.7% growth rate, and the long-term trend has been just over 2%. So a little bit below trend, but positive. So a soft landing. Now, switching gears a little bit to other, I guess, sources of volatility. We do have, of course, our U.S. elections coming up, where we've talked about really all the three segments: the White House, the Senate, and the House of Representatives. Everything's up for grabs for sure. It's all sort of too early to tell. It's too tight to tell. One thing we have done, our colleague Brian Gardner draws on some work to sort of gauge what are the top most important issues to voters. And the top of the list is inflation and prices. So we'll see if Democrats kind of claim victory, even though prices themselves are kind of elevated. Jobs and the economy, that's held up pretty well. And then immigration. Those are sort of the top three most important issues. And for the sort of independent voters, so think about people who might be the swing votes, those three categories add up to 56%, I think, of those independent voters capture one of those three as the most important issue. And so bottom line is that the debate in some ways and the platforms and policies that are going to be floated by the candidates will inevitably anchor on those topics for sure. In any event, with what was sort of a reversal where we saw Trump sort of underperform Harris in their debate recently, Harris is in the sort of predicted polls edged just slightly ahead overall, and so probabilities are moving around. And again, I think as we've said all along, it's sort of a little too close to call. I've been talking to people about, importantly, focusing more on platform than people when it comes to what we're analyzing. And so think about segments of the corporate world and the economy, like financials, energy, alternative energy, the idea of tech companies and maybe the focus on M&A, and sort of avoiding big mergers and things like that. Those are issues really that are going to get flushed out as we learn more and more about the platforms of both Trump and Harris, and then the probabilities of change based upon how the entire election goes. But even things like, of course, strategy with trade and China and how that might affect things. In any event, as it relates to the election, generally speaking, I think it falls into the headwind category in the sense that we do typically see increased volatility in October and November leading up to the election and sort of through the election as that uncertainty triggers volatility. And so, the bottom line is we should be ready for that and expect it. Now, turning to the markets more broadly, another minor tailwind that showed itself is with this Fed action and signals from the Fed, we're seeing short and intermediate bond yields fall. So, for example, if we go back to October of 2023, just to give you a sense, the 2-year rate sat above 5%, and it was above the 10-year rate. So we had what was an inversion, and a little before that, in July of that year, the inversion was even greater. Well, basically that inversion has disappeared. So if we're analyzing the 10-year to the 2-year rate, the 10-year now exceeds the 2-year, and the short end of the curve is starting to come down as the Fed cuts. And the bottom line is that lack of an inversion is sort of a signal that we may well experience a soft landing. So As it relates to yields more generally, of course, as we've talked about before, generally speaking, across various categories of fixed income, yields are looking attractive. By the way, as it relates to being fully invested, or not fully, but significantly invested in cash, especially with long-term assets, like assets that are intended for long-term, we continue to think this is a very good time to start to put that money back to work, because we do expect, as the Fed cuts, for the cash rates to come down corresponding to those cuts, and sometimes in advance of those cuts. And so, the punchline here is that it's a good time to take a step back and start to get reinvested. Now, people are always wondering about the stock market. And as we've talked about in the last number of months, on a PE basis, price to earnings, the cap-weighted market, in this case I'm looking at the S&P 500, remains at a premium. It's roughly in line with its all-time high. And it's basically a 23% premium to its 10-year average in terms of PE. So that's a richly valued market. What that tells me is all these tailwinds aren't necessarily about driving markets significantly higher. So a lot of times when the Fed's cutting, that happens and the market really goes up. We don't necessarily think that's going to happen here. It's more about the tailwinds sort of supporting these rich valuations, that the downside risk is still there, but maybe not as significant. And of course, as headwinds show themselves, that could still trigger some downward movement in the market. In any event, the other thing that's in focus is really when it comes to profitability and earnings growth. We're still seeing very strong numbers. And so, for example, the estimated EPS growth for the S&P 500 in the coming years is at about 15%. When we break that into the Magnificent Seven, they represent about a 19% growth rate. For the rest of the market, 13, so not as good as Mag 7, but 13 is a big number, right? So I think another sort of tailwind and sense here is that what's holding up and supporting these higher levels of valuation is the anticipation of increased improvement in profitability and increased improvement in earnings. So again, some data and expectations around a soft landing, almost like a stronger than expected environment for businesses, and maybe the consumer remaining engaged and therefore supporting this earnings growth. Now, of course, we're watching for headwinds and issues, and mindful that if some things present themselves, could be a slowdown in the consumer, as we've talked about, could be an external event. We've got a lot of hot spots in terms of military conflict around the world, maybe a cyber attack, something like that. There could be almost like a whole list of things that could trigger nerves in the markets and a downturn and a slowdown in the economy, really, to correspond with that. But as it relates to the market overall, we're seeing a broadening of the market. So, for example, when we look at fiscal year 2025 growth by sector, we're seeing sectors like healthcare. We're seeing sectors like materials. We're seeing sectors like consumer discretionary and industrials that are holding up, and where those are some of the bigger growth rates that we're expecting to see across sectors in 2025. Tech is still holding up well. It's sort of at the higher end of the range. But the bottom line is that we're seeing the growth broaden out a little bit. And in fact, as we've reported before, essentially July 10th of this year ended up being kind of a bit of a shift where rotation started to occur, where that cap-weighted index, in this case the S&P 500, has underperformed the equal-weighted index. We've seen the Magnificent Seven since that date give back a little bit. By the latest cut I looked at, it's down a little over 6%. And so the broadening of the market has happened. The small cap stocks since that date are up a little over 10%, et cetera. And so, the bottom line is we do keep an eye on these patterns, right? That for a good long time, everybody was talking about the cap-weighted S&P 500. And yet what we've seen since July 10th is a rotation where the other stocks and sort of the equal weighted index is outperformed by a little over 6%. And so, bottom line is these things happen, these things come and go. Another piece of data that we're going to keep an eye on, or a trend, is over longer periods, like multiple decades, we've seen sometimes the U.S. outperform non-U.S. And sometimes the other way around. It happens to be since really the financial crisis that the U.S. market has outperformed. But we have to be mindful that we do have these periods in the past when the dominance kind of shifts around. So, we're going to be focusing on that a bit looking forward. And then speaking of looking forward, we'll be keeping an eye on the data. Generally, we'll watch the consumer, we'll watch the Fed, we'll watch inflation, we'll watch, consumer action like retail sales, data on purchasing managers' indices around businesses, et cetera, et cetera. Just keep an eye on where things are headed. Because again, I think we're in this period where we've seen some good tailwinds. The Fed is now in a cutting cycle. That's going to be supportive. And that argues for, on average, more good news than bad news. But we know we could watch for a slowdown. We could watch for an external event and the increased volatility from the uncertainties of the elections. These are all things that are part of the calculus as we look at things going forward. Would invite you to check out stiefelinsights.com, where this series and a bunch of other work is hosted. Thank you so much for listening this month, and we'll catch you next time.
Thanks for listening to Stifel's Investment Strategy Brief. Be sure to subscribe wherever you're listening to automatically receive each month's podcast in your feed.